I hope everybody's having a good day. We are just about to get started. I want to thank those who have joined us live. I know that usually these, particularly this time of day, are probably going to be more viewed on our YouTube channel, our recording, than they are on a live session. So, for anybody who has chimed in live today, I appreciate it. And I'm not looking at participants, so I'm not sure who's on and who's not. But I want to spend time today. This is our second episode. So I want to talk today a little bit more about why we're doing this course. We're going to talk a little bit about cash management, and we're going to get a little bit into tax and savings. I tell I tell everyone, and regardless if you are male or female clients or couples, that what we do or what I spend time doing for folks is to organize, clarify, and simplify. Everything that we do, regardless of these topics, is to not overwhelm. Part of why we do this in 4 sessions. And also when we meet with our clients or on an ongoing basis, we divide those up into quarters or semi-annually, if you will, because we do not want to overwhelm people. Again, organization, clarification, and simplification are something that I want to promote to people, as I want to remove stress in their lives, not create more. So that's part of why we put this course together, is to make sure that people have the means to think, to ask questions, to come, and hopefully these courses give you some questions you can ask others, whether CPA or an attorney or your insurance agent, or if you're already working with a financial advisor, him or her. It will give you some tools that maybe you can use to talk, to ask good questions, and to make sure that you understand what you are doing for your family, your household. So we understand that, and that's why we're doing these courses. Again, they are on our YouTube channel. At least episode one is already on. So if you've missed that one or want to jump on that one and rewatch it later, it's there. You can Google Highland Trust Partners YouTube. This one should be live maybe in the next week on that channel. Again, you can do that. So you can invite friends and family and others who are single to take a look and see if there's anything that can help them as well. But I love having a library of these as we go forward. That way you have some reference points to look back at in the future. I'm going to click my video off. That way we can focus on content instead of me actually talking. So these are the reasons that why part of why I put something like this together just for women. I said this in part one, episode one. I was really asked to do this a couple of years ago by some of my clients who are either widowed or divorced. They had some particular questions or concerns with them, either at younger ages. When I say younger, those maybe under 65, they're now the single income earner for the household. They may have children still at home, or young adult children that they're worried about. They may be getting later into their retirement planning or working years. And as a single income household, there's just some unique challenges for anybody, men or women in single income households, but particularly women, and because that's really going to come more to the responsibility for children and in caring for their parents and some other things that females tend to do in life that are a little bit different than men. And I really wanted to do these to really reduce stress and make you happier. So if you can get something out of this, again, that you can maybe take some stress out of your life, that's awesome. And second main reason is just I care. I care about that my wife really understands our household finances as a financial planner. And she would say I'm the finance person for our family. I don't look at it that way. I want her to be very involved in this because more than likely she is going to outlive me. And I want her to understand in great detail how to run the household for her really effectively if I weren't there. So it's not me taking control of finances, it's us doing it together. And having a daughter. I want her to, when she finally does marry, that she if she does marry us, if she makes that choice, that she has power and control, that she understands, and that she does not give that up. And if something were to go wrong in the marriage, the relationship, that she feels very good at where she is on her financial level, financial knowledge, and can move forward from there. So if I can teach anything to anyone, but particularly women, young women are in as they go into relationships, is to really understand these things we're going to talk about a little bit today so that they can have power over the financial situation. And it doesn't mean they're combative or in a relationship. It just means that this is an even kill. And this is it's a division of love, division of labor with things that we do in relationships as well. And then when an event does happen, as in a divorce or a death, that that life event will not throw them off the rails financially. I truly believe that. There are some differences between women who are single and always been single, especially younger women who are single. And just goes back to what I said about my daughter, just making sure that you already have these tools in your toolbox and you understand these really well and you're tracking these really well when you go into relationships versus those who have gone through a situation in a divorce. I know that's different than somebody who's even widowed. I had that conversation with someone today, just about how someone, particularly a young widow, but who's lost their husband. I mean, they didn't choose that. That didn't happen in a. I mean, they're always going to love him more than likely. They may get remarried at some point, but they didn't fall out of love with him. He passed away from them, as opposed to someone who went through a divorce or some other challenges there as well. So we're going to talk about a little bit about each of those. But if you're one of those particulars, if you're just a single female or never been married, or you've gone through a divorce, or you're widowed, particularly younger widow and under 65. There's some unique planning conversations that I can send to you or talk to you about one-on-one if you ever want to do that. So we're going to start a little bit with household cash management. These are some of the questions that I like people just to be able to answer yes or no, or to answer to themselves or to others. Maybe it's a family member or somebody like us as a planner that they feel they could focus on things like this. So the first, and I'll talk a little bit deeper into it. The word budget scares people. I understand that. We have conversations with clients all the time about, do they have a budget? Now, a budget does not mean it shouldn't have a negative connotation. It just does. So what people think of when they think of a budget is what I can't do. It's I don't want to spend time on looking at the things I have to spend money on because it just tells me what I can't spend money on. So what I did was create, instead of a budget plan, it's called a spending plan. I love people being able to spend money. I know there's some people that need to save a little bit more than they save. I know there's some people that maybe need to kind of peel back some of the spending a little bit so they can do the things in life that they really are more important to them. But I do understand that that budget has a negative word or a negative connotation to it, and that's why I created something called a spending plan. So what the spending plan does is it's basically having fun. Okay. So I won't think budget or spending plans as a means to have fun. And having fun means you get to do what you want to do. You're able to find a way to spend money on the things you want to do. And that's where we start. So I will, on our plan model, we would ask someone to, if they went through this experiment, is the first, give us the things, or write down the things you love to spend money on, the things you want to do and you would love to spend money on, instead of starting with what do I have to spend money on. Then we look at, where do you like to save? So it could be saving for my children, it could be saving for my future retirement, it could be saving for vacations. So what do you love to spend money on? What do you love to save for? And then what do you have to? We all have the have tos in our lives. So that's the third step. What do you have to spend money on? And then, of course, the fourth variable, which is a big one, is how much do you how much do you earn to be able to cover all of those? And we work backwards. Because what I want to get you to a point, our client to a point, is that they feel like they are able to do everything they want to do. They're paying the bills they have to pay. They are saving the places they feel they have to save. And sometimes we have to give some people some advice of things to save a little bit differently for. We know that. And then it gets them to the point that they can still comfortably spend money on the things that they want to without regret. I want people to spend money. I want people to enjoy life. I don't like it when people just pinch pennies all the time and build up large accounts and don't enjoy it. Of course, there are things we need to save for retirement, things such as that, but we can also enjoy the time we have here. And particularly those who've been through a divorce or a death, they're widow now, they understand that life with a partner can be, limited. It doesn't mean you're going to be married 50 or 60 years. So, how do we find a way to have fun? And that's part of what this first process goes into, and we need to track it. So one difficulty that some people have is able to say, okay, that makes sense. I maybe can look at what I spend money on, but I don't want to look at it every day. So we need to find an easier way that we can help clients, or you can help yourself track things. I'm going to give you two tools, so two apps that work really well for that. One's called YNAB. Is You Need a Budget. Again, I don't love the word budget either, but it's in the name of the app. So it's YNAB. It's a subscription. Both these are subscription services, but fairly cheap. So you need a budget. It's a little bit more detailed, but it really does a good job of doing some tracking for you. I compared this to like if you were going to go into a health mode where you're trying to count your calories or go to the gym regularly, lose some, maybe lose some weight, or just whatever it is, healthier eating, you're not going to be able to do it really well once you track it. I've always said with everything, if there's not tracking, it doesn't get done. But we need to make it easier. We can help you with that too. But these two apps, one, you need a budget. Two, Pocket Guard. Pocket Guard's a little bit more simple. It doesn't have all the fine details maybe of the YNAB, so it's a little easier for people just starting who really hate to track things. It makes it a little easier to work with. So those are two things as far as tracking goes. Once we get to the point of someone under, particularly if you're younger with maybe young adult children or still raising children in the household, teach your kids. So if we ever get you to the point or you get yourself to the point of, okay, I'm able to understand what I spend and I'm enjoying I don't feel guilty spending money now because I have a good tracking system. I understand I can do it without regret. Things are still going to work out well for me in the future based on how things are going, that you need to teach your children. So the one thing we've talked about 1,000 times over, I wish school systems did a better job of this. I don't care what school your kids ever went to, they just don't. They need to be taught, and nobody teaches it better than their moms, quite honestly. I mean, I've seen that even from my wife. As a finance person myself, once my wife was able to get to grips with things like this, which she doesn't like either, the kids related to it better with her because no, she didn't really like it. And they just somehow she was able to talk to them better about it than I even could. So it just comes out better for moms to do that. But teach children is huge. And once we know expenses, once we know the important ones and the ones we want to have fun doing, we'll talk more about that in our next session too. But we're going to talk about the income. So as far as how that works in your future, how that pays for certain things. But knowing expenses is the first key before we even start talking about the income side to cover expenses. That's episode 3. So we'll dig into that a little bit more on our next episode. Then once you get that, it's real easy to start looking at personal financial statements and balance sheets. So I like people to know where they stand at all times, just what they own and what they owe. I think that's key. There are tools that do that, but once you get the budget or spending plan put in place, then the financial statement and balance sheet become a little bit easier. They're not as daunting once we get to that point. Another thing that everybody needs to know is your interest rate. So if what you're paying on your debt is big, particularly if you're going through and have a life event and again a death or divorce, and you're left with covering some of the liabilities, what are you paying on those liabilities? What is your interest rate on those? Should you look at refinancing that? Should you look at paying that off? And of course, if you do a refinance as a single person, now you picked up that debt, your credit score is going to be more now because the bank is not looking at a joint credit score between you and a spouse. They're looking at yours individually. So even before a life event happens, and I don't think most people watching this are probably married at the time, but you can teach your children this, your daughters particularly, is to keep their credit score update. Know what that is. A great app to keep your credit score to pay attention to it is LifeLock. I don't know how many people use LifeLock. I recommend it all the time to every client I ever talk to. You can pull your Equifax, TransUnion, Experian scores off of that too, and it will keep it up to date if you set it up correctly, which most people tend to do. It's not that difficult. It's also a subscription service. So subscription services to me, on a side note, they're just better security protected. The free ones, I always worry about being more at risk for hacking. The paid ones are a little bit more protection. LifeLock is a protection service anyway, if you don't know what it is. But it will update your credit scores. It will track it for you. I just think it's good to make sure as you go through a life, before a life event happens, but after you go through a life event, start paying attention to your scores because you may need to do some things as an individual income earner, single income earner that you're going to need a pretty good credit score for. And I'll talk about credit scores in a minute as well. And then financial ratios, that's going to come up as well in just a second when we go over financial, we'll go over your credit scores. So I've asked all the time about emergency funds. So how much should I keep as an emergency fund? I didn't build this slide. I borrowed this slide. It's a 6 months of salary, as it says. That's a cookie cutter. So it depends greatly. It definitely depends with single household earners. It depends where you are, what stage of life you're in, whether you're a young single female, or whether whether you went through a divorce with young children or any age children coming that you're raising, or if you're in 56, 57, 58, children or adults and you're widowed. So it really depends. A lot of what I talk about with emergency funds is not how much income you earn. It's going back to that budget spending plan, is how much expenses do you have. So I'm more on the let's say for emergencies based on your expenses than how much income. That can be a different number. It could be a very similar number based on both those scenarios. So my point is, it's not a cookie cutter answer. I think that you need to, some's always better than none, but I would want to make sure, depending on your personal situation, that you have the right amount sitting somewhere for an emergency to cover debt obligations or other expenses that you may have in your household. The reason I'm pretty careful about making sure it is customized to you and not cookie cutters, because this should be cash that's sitting very available. It should be liquid, ready to use at any given time for emergencies. It should be in a bank account that you can draw on quickly, easily, with no transaction costs or very low transaction costs. So what I try to discourage people is having too much there for emergency fund, more than they really need, because as a single individual, we need to make sure our money's working for us somehow. So what we're not sitting in easy, flexible, usually it's low interest accounts that you can pull from for emergencies. If it's sitting there, it's not being utilized in something else that could be growing and making money for you for something else later. So I discourage people to have too little or too much. It's a balance, and it should be customized to you. So that's going to be something you talk to others about, as far as how much you keep in cash in the bank for emergencies, and is it too much or too little? It's a great question to ask somebody. Emergency funds on this slide too. Paying off debt. So of course, it's a rule of thumb you've heard a bunch, as far as paying off debt that's particularly high interest. You start with the high interest debt first and work your way down. Dave Ramsey, I think, compares it to a snowball effect. But what we talk about, obviously, if you widow or divorce at a younger age, that's under 65 or so, you may inherit some debt. So can you pay off that debt? Should you pay off that debt? What I also discourage people from doing and having these conversations is to sacrifice saving for other things or enjoying life again, having fun to some degree. Paying off your debt instead of doing those two things. It's a balance. So yes, you may inherit some high interest debt out there, but we need to make sure before you start paying off whatever that is, the high interest credit cards or higher interest HELOCs or those types of things, particularly when we get down to the mortgage, maybe your lower interest debt. Before we start dumping money into paying those things, we need to make sure your emergency fund is covered. We need to make sure that you are putting money aside in savings for the things that you're going to need in the rest of your life, and that money makes money on itself, as well as having enjoying life. Also, we're not doing enjoyment of things and then everything else just seems like a chore. It just seems difficult for us. Making sure proper health and life insurance are there for you. It's when you go through a life event like a death or a divorce, of course, you need to make sure. You also need property casualty is not on there either. A big one that people forget sometimes is your P&C insurance. Make sure your insurance agent is also looking at your property casualty insurance now, that you have the right coverage on everything that you need for property casualty. But just example, car insurance. Sometimes you can lose group rates because you don't have a driver. If a spouse, you don't have that spouse any longer. So make sure your beneficiary designations are up to date. I think most people going through a life event, somebody's helping them through that. Most of the times, I still have cases every year where somebody didn't change that on one of their coverages. So they still have a spouse that's no longer with them. And we need to make sure, you need to make sure that is 100% done. And then consider long-term care insurance. So when people ask me all the time, do we recommend long-term care insurance? Case by case, there is no cookie cutter to that either. Some people very well self-insure themselves, but here's what I see. I encourage more married females even, to buy some type or have some type of long-term care coverage, because one, females usually outlive us. So I would assume my wife's going to outlive me, as I mentioned earlier. So who is going to help her? If something happened to me, she may be my primary caregiver in my older age if I have some kind of disability or have some kind of mental incapacity. So she may help me and I won't need a facility as much. However, if I'm gone before her, who's going to help her? So she probably is going to need a facility, because the one thing that a parent will always say, I've said, as my wife says all the time, I do not want to put this on my kids. I don't want to have it where my kids are either having to physically care for me or financially care for me, or both. So if we can do anything with widows and divorcees, we do talk a lot about potentially what long-term care would look like if your health ever declines, because we want to make sure your children are not having to step in and do that. And then, of course, Medicare coverage. So once you get to be 65 or close to 65, look at your Medicare benefits or what is out there for you as well. So this is all like a checklist. Again, this is to develop some questions that you can talk to people about, whether it's us or somebody else is fine. But as long as you have some ideas and things to discuss, that's great. Financial ratios get deep. So I'm brushing this with this comment. We actually treat most households like a business, which means that as a business owner owning this firm, we look at these ratios like this all the time for how the business operates. But I want to see how the household operates too. So we want to make sure, and credit scores is on here, which we've already talked about, but the other five, it's to assure that if something were to happen, that you are going to be able to cover your liabilities, that you're going to have enough cash available to afford to do the things that you need to do, make the payments you need to make. We don't have to go deep into what each of these necessarily mean. But my point is, we want to make sure that if you ever have an issue as a single income household, that you are able to, you're doing the right things to help yourselves. So sometimes I do these with my clients and I don't even talk to them about their savings ratio or their debt to asset ratio. I'm doing it back office just to make sure they're doing okay. But I may come out with a recommendation for them to say, we need to improve X. And then I may go a little bit deeper into Y, what that ratio really means when I look at that. But that's some of the cash management ideas that I want to put out there. Spend a couple minutes on tax considerations. So, and I've had so many conversations with CPAs about this for our widowed and divorced clients, and a lot of these recommendations actually come from them. My first recommendation is meet with your CPA. Hopefully, everybody, at least we just got through tax filing, hopefully meet with their CPAs annually. Once a life event occurs is huge. If you just recently went through a divorce or recently lost your spouse, your husband, I would 100% say the soon as you filed that tax return for that past year after that event, life event, try to peel some time, and your CPA should be more than willing to do this. Peel some time away from him or with him or her and go through your personal situation, because there is some differences as a filing as a couple as filing as a single. So give you some ideas that we talk about with my CPA friends is, your tax tier is going to be different. You're not married filing anymore. It's not married filing jointly. You're filing as a single. So your tiers are different single than they are as a couple. That could be that could change your tax status, your tax yield. So make sure that is part of that conversation. Again, they should be able to do that with you easily. One thing to look at that we talk about are your dependents correct? So if you were to lose, if you were to lose a parent who's passed away, if you had your parent, so some people, so my brother has my mother as a dependent, for example, because she's disabled. So he uses her dependent once she, and that affects his tax return. He actually gets he gets his taxes are lower because he's filing her as a dependent. Once she passes away, he's not getting that anymore. So if a parent passes, you're using them as a dependent. You go through a divorce, only one of you can claim the children. So, or who through the divorce settlement is actually going to be able to claim the children on their tax return? That's a great conversation. Hopefully, attorneys cover that with you, but I've seen too many cases where they hadn't. And then any child over 19 and not a full-time student. So if you have a child over 19, not a full-time student, they're no longer a dependent, so you can't claim that. So have that dependency conversation with your CPA at that point as well, or when other life events occur, like death of a parent or child reaches 19 and not going as a full-time student. Also, you need to make sure that your withholdings are correct. So and that probably means more as an individual than even filing jointly. It means a lot to both, but if you're filing individual, you're the single income household, single income earner, you need your money more than anybody. You need it, any dollar that you can keep in pocket that you can use for emergency funds or savings into retirement or other things, is big. So if someone tells me they're single or a couple, but somebody tells they're single and they got back after they filed their taxes and they got money back from the IRS, they need to change their withholdings, and talk to their CPA about that, because basically you're letting the IRS borrow your money for free. They're not giving you interest on it. So you never need a refund. You don't really need to pay a lot either when you file your taxes. So it's making sure that year over year your return, you're breaking even, that you're not paying more at tax filing and you're not getting back any, so you can keep that money to do other things for you. Let's go a little bit deeper. Tax bracket for children. So if you have adult children, we're going to talk about estate planning with you a little bit more at some point. That if we're going to want to know, or you're going to need to know you don't need to get too nosy on how much your children are earning per se, but you're going to want to know whether tax bracket is, because there's some estate planning techniques we want to look at for you or somebody needs to look at for you to make sure that the assets that pass to children are passed correctly as far as who gets what based on their income or their tax bracket. That's pretty big. I'll talk more about Social Security taxation when we do our episode 3, because we'll talk about income in episode 3, which will include Social Security as a benefit. So that's coming up soon. We will also, and yeah, we'll go a little bit deeper into that. But just as a side note, Social Security is taxed over a certain threshold. So you'll have conversations with us for sure, because it's different for singles and joint. So if your CPA should be already talking about this as you get closer to filing for Social Security. But it's something that we will definitely, or you will want to talk to someone about when you get close to 62, whether you should actually take it at 62, take it at full retirement age, or wait till you're 70. That's as important. That's very important for an individual. It's important for couples too, but it's very important for individuals to go through that, as well as retirement account distributions. So as you're saving into your business retirement accounts, your 401ks, 403bs, those types of things, as well as maybe separate IRAs. We want to talk more about how those distributions may impact you or what they need to do for you when you get to that point. Because again, there's one income potentially in the household at that point, and that RMDs or retirement account distributions may be one of your primary sources of income at that stage. But we just want to make sure that that's the right thing, or as we plan to that point. If we wait till 72, 73, or 75 to have that conversation, it's a little late. So we need to talk about that about 10 or 15 years prior. Okay, I left this slide in here. This is for those who are divorced, mainly, or solely. So the only reason I left it in, I did take it out and I added it back actually, because I had 2 conversations recently just about transfer of property from former spouse in a divorce settlement, and about what's capital gains and not. So need them to understand that. I just left this in here for anyone that's going to listen to this video or maybe watching live now who is divorced and didn't understand transfer of property to a former spouse. Also things such as responsibility for outstanding taxes, as far as when you to it when you're a couple versus now single. A big one on here is dependent children, which I mentioned a second ago. So which spouse gets that exemption for dependent children? Be sure and talk about that in the settlement. I think that is tremendous to talk about in the divorce settlement. And also how alimony affects your taxes. There's something that, people sometimes don't understand how alimony is treated as a tax payment when you're going through a divorce. So these are just some takeaways that you may want to have a conversation with your CPA about if you just recently or going to go through a divorce sometime in the very near future. All right, the last slide I'm going to give us today, and I'll talk about these a little more briefly because some of this is going to come up again in episode 3 because they in income, because realistically, a lot of these tools sitting in front of us on the slide, the reason we save into these is because we want to use them later to supplement something, either expenses for maybe healthcare, like a health savings account, an HSA, or retirement income supplement or retirement expense supplement, like a 401k, SEP, or IRA. What I wanted to hit on this a little bit instead of the income side was just how things are taxed some and how we need to think about savings into things. And this is when we get into the difference a little bit between filing jointly and filing single or two income households versus one income household. So I think everybody knows 401ks, 403bs, SEP simples, and IRAs. The second bullet point, they're tax deferred savings. You pay tax on them later. Okay, so we'll save into those. We get the tax benefit today, which works well for people in higher income tax brackets. It works really well for some people in higher income tax brackets. So if you are now an individual income or single income household, you may not, and your tax year changes though, but you may not need maybe that deferral to save on income as much as when you were a joint income household. So I bring it up because for a lot of our singles, we talk more about Roth savings. Roth, that's the third bullet point. In case you don't know what that is, you don't get the deferral or the help today on tax savings. You get it later in retirement years, down the road. So it's not taxed then, nor are the earnings taxed then. I want you at some point, if you're doing any of the first two bullet points, to eventually talk to someone about will Roth benefit you, because all those in bullet point 1, the first bullet point, they do have you can save Roth in those as well. Some people don't know that 403bs, 401ks, SEP simples do have the ability to have a Roth feature in there. I just want you to have that ammunition to yourself to ask your CPA or ask an advisor or a consultant or planner, any people like us. Will Roth benefit me now as a single, as opposed to maybe when I was a couple doing it as a deferred savings? That's big. Another thing I think is big for singles is HSAs. An HSA it gets a tax benefit for sure, which I do love. It's a deferral. But it's putting money on the shelf for healthcare. So the way I look at it is that this is money that's going, I didn't even think about this when I had the slide up. I'll use the piggy bank example. So this is money I'm putting in that piggy bank on the left on a shelf. I'm not going to break that piggy bank until I'm retired and I need some help with something that Medicare is not covering. That could be a Medicare supplement to me, and it has tax benefits for that. So I think that's very important for, again, anybody, couples as well. But I think for singles, if they can afford in saving to put some money in an HSA, that would benefit them tremendously. And so that's tax benefit. The CDs and the money markets, I put these on here because that should be used for your emergency funds. That's your emergency fund accounts. Their interest rates aren't probably fantastic. Maybe you can find some high yield money markets that do okay. But if you can get your money quick, you can get it pretty much back free. You may have some earnings on it, which are taxed at your income tax bracket, regardless. But it's a way. Those are the vehicles used. Don't put emergency fund money in taxable investments with a firm like us or one of the other big wire firms that are out there. Taxable investments are for longer term. They're not for emergency fund money. So cash, whatever formula is worked out for you in regards whether it's income based or expense based, that amount of money that says you're Mrs. Smith, you should have X dollars saved in emergency fund, it should go in as those vehicles right there because you can get your money quick. You can get it out really fast. And you don't have to worry too much on the tax treatment of it because even though it's going to be taxed at your income tax bracket, it doesn't pay that much. It's not going to make a ton. Lastly on that list is taxable investments. Most people are familiar with what that really means. That's your stocks, that's your bonds, that's your mutual funds, your exchange traded funds, those types of things. What I want you to be careful with those, or to talk to people like us about, or whoever you're working with about, is how's the tax treatment on those? Because you can have investments for us, and we try to do our best to be tax efficient with those anyway, regardless of your tax situation. With preferred dividends that tax you at a lower rate, or using long-term capital gains, or using losses to offset gains. So we're trying to be really tax efficient with those anyway. But I want you to make sure you're talking to someone about your personal now income tax situation as an individual, and that may involve your CPA in this conversation, of course, and to ask, am I being as tax efficient as possible on my investment savings and my taxable investment savings? And guys, I think that's really important. That's your longer term stuff, like your 401ks and things like that as well. But there is a difference in that, being, again, individual filing versus joint filing. So it's just important to have that conversation with somebody after you go through the life event, or it could be several years after, just to make sure. Just don't wait too long to make sure that you're doing that. The last thing I'm going to put on just mention on this, which is not on the slide, is your 529s for your kids. This could have gone on several slides, honestly. But if it's a savings tool. If you have young children, it may benefit you to consider some of that. Some of this is going to depend on the divorce decree. If you go through a divorce, of course, there's plenty of people who lose their spouse when they still have young kids at home as well. But it's to make sure we'll use divorce in this example mainly, but who's going to take care of the college cost. I've had this come up 3 to 4 times over the last maybe 16 months with different clients, that and all these clients were the female that went through the divorce. Still confusion of who is responsible for college costs, which colleges are allowed that the kids can go to if they go to a certain college that's not on the list, because it really was never a list. That's more expensive than everything else, in state, out of state. I'm only going to pay for this. You have to cover that. So it's very, very important for those of you who have gone through a separation, and this was not discussed in great detail through the divorce, to start talking about that as soon as humanly possible with someone, and we may get your attorney back involved with that as well. So that's going to be the end of our session today. Again, I just wanted to give talking points. I wanted to have this recorded, obviously, so people can pull back on this as a reference piece if they need to, share with others if they need to. I'm hoping that someone took something, at least one thing away, that they maybe can put into their lives, or be able to ask their accountant or their attorney, or people like us, am I doing the right thing? I don't want you to make a mistake. We're all going to make mistakes. I'm not saying we're perfect in being able to get away from that part, but some of these things, by having just the conversations, by asking the questions, it will keep us from making more mistakes that sometimes we can't fix. Um, it's just too late. So if I can help with that, or provide some information to help with that, I'm thrilled. If you need anything, or have any further follow-up questions or conversation pieces you want to make, just feel free to call or email me. I'm happy to talk to you about this. These are for education purposes, to get you thinking. But I'm more than willing and happy to have one-on-ones with anybody that wants to ask anything. So with that, I'm going to let you go for the day. I hope you have a good rest of your day, and thank you for tuning in. Bye bye.